and welcome to this edition of Market Guru. Joining me today is our Sukumar. Well, Sukumar, thank you very much for joining us here on the show. We've seen some developments in the last few days, whether it was the ECB's move or whether it was the US Fed's move. What is your own assessment at this point of time regarding global markets?
I think the uncertainty continues in the global economies and the global markets. But the point I would like to make is the implied risk premium for equities is extremely elevated at this point of time. And equity as an asset class is definitely very attractive compared to the other asset classes, provided we don't have a collapse in earnings. It doesn't look at this point of time that there's going to be a very serious collapse in earnings. So which means that over a period of time, I think people can shift to equities compared to the other asset classes, driving flows into equities. Regarding emerging markets, of course, there are issues regarding growth, etc. So those concerns are increasing at this point of time. But I think valuations will be more important consideration for value investors compared to the growth momentum, and as long as there's going to be support in valuations and abatement of risk aversion, I think generally I think there could be flows into equity markets.
Sukumar, just to stay with Europe, from whatever you have seen and heard in the last 3 or 4 days, would you say that things are getting better there, or do you think they are getting worse?
I don't think it's getting better or worse. I think the debate is still on to find out what is the best solution to the problems that they are facing at this point of time. And it looks like from various statements that they are buying time rather than it doesn't look like they have reached conclusion yet.
How are the Indian markets from a valuation point of view looking to you at this point of time? We were one of the worst performing markets last year in dollar terms at the end of the year 2011. Today, at the levels that we are at, are these valuations attractive? Are these valuations cheap? How would you describe the current valuations?
If you look at the market, it's neither very cheap nor expensive. So I think it is close probably to the fair value. But most investors do not buy the market, they buy individual stocks. And there I think there is a divergence. There are some stocks which present good value because they are very well positioned in their respective spheres of business. And there are companies which did well because of the momentum in the economy, but did not have sustainable competitive advantages and nor good management, and those type of companies might be slipping up, and some of them might be dropping dead.
Sukumar, after 2 months of seeing FII outflows, we have seen a fairly strong July when it comes to inflows from FIIs. How would you read that? According to you, what do you think prompted that kind of a strong inflow coming back into our market?
I would see that as something cyclical rather than any structural shift happening. India was a market which had underperformed, and it had looked relatively more expensive, and after the underperformance and also after the recalibration some of the investors might have gone through, I think they might have felt they might have seen some opportunities in the Indian market. I don't see a structural shift in a view vis-a-vis India. I think most people continue to be positive on the long-term prospects and disappointed on how we have dealt with the various issues in the last few quarters.
Coming more specifically to India in comparison to some of its peers in the Asian or the emerging markets basket, how does India look to you?
It's totally different qualitatively compared to other markets. I think each market has certain attendant risks, and India's risks are quite different from the other markets. Our demand is strong. It's driven by local consumption, so So I think in that respect it's quite different from many of the other markets where exports is a significant component of growth, and also we are balanced between investment spending and consumption spending. However, we have a lot of risks in terms of how we are governed, the ability to reach consensus on various issues and move ahead with reforms. I think that's been a challenge as far as India is concerned, and that's impacted the growth. And also, we have fiscal imbalances which many of the other economies do not have. So we have positives and negatives which are quite different from the other countries. So from a diversification point of view, I think the investors have to be in multiple markets, and I think India is a very good source of diversification, because the risks that we face are very different from the risks that other markets face.
Talking about growth, Sukumar, there has been a lot of numbers that have come out in terms of the expectations both from the RBI, from the Finance Ministry. What is your own assessment about India growing by the end of this year at? What could that rate be according to you?
I think this year's number is not as important as the trend that we are going to see. When we are going to see the deceleration end and see acceleration coming, I think the timing of that is more important than what the absolute level of growth is going to be. So I'm hopeful that by either the end of the year or in the first quarter of next year, things can improve if some of the pending issues are sorted out. I think investment spending can improve from here, and if the global risk aversion reduces, foreign investment can also increase. So I do think there's a good possibility that there can be a turnaround in the investment climate sometime in the next 6 to 9 months. And I think that will be a key driver of the change in the direction of the growth.
You have in the past talked about the fact that Capex in India Inc. still remains a concern, and the slowdown in Capex has largely happened because of policy uncertainty. Do you see that as continuing to be a big problem, at least for the next 3 to 6 months, or do you think that you are seeing some signs of traction when you speak to corporates across the board?
So we have to divide that into Capex, which is related to corporate capacity expansion, and then we have to look at infrastructure spending. I think the infrastructure spending will depend by and large on policy hurdles and clearances coming through. As long as some progress can be made on either of the two, I think there can be some improvement on the infrastructure Capex. As far as the corporate Capex is concerned, I think it's a function of the capacity utilization levels as well as the outlook in terms of demand growth. I think capacity utilizations are generally improving, and so in some sectors at least, some companies might want to expand capacities. And also there are some companies, especially in the metals and mineral sector, they were waiting for several years for clearance, environmental clearances and land acquisition clearances. Some of them have got that, and so they might proceed with the Capex. So I think it's going to be more cyclical in the case of the corporate Capex, and I think there could be some cyclical upturn coming sometime.
Sukumar, we have seen a fairly large number of earnings that have already been announced, though the season hasn't ended yet. But what's your own assessment? Have they left you disappointed or pretty much on track? And if you were to see the next 6 to 12 months, then is there going to be a greater period of pain when it comes to earnings before we actually get back to the growth trajectory?
I think the corporate sector is going to be in a consolidation phase. There will be companies which will see a big improvement in earnings because either they are gaining market share or they are gaining pricing power, and so they are able to improve the margins. or they're working on cost structures and so on. And there are a lot of companies which are not strong enough, and they're being basically survivors or creations of the bull cycle in the economy, and those type of companies might continue to go down. So I think we are going to see some sort of a two-speed corporate sector, one part of the corporate sector gaining momentum and others falling by the wayside. I think that will be the situation.
How are you viewing the currency, the rupee against the dollar? Do you believe that we've seen the worst of it?
I think the rupee is undervalued at this point of time. At the same time, it's very difficult to say that we have seen the worst, because we still run a current account deficit, and still I think there is nervousness and risk averseness in the risk aversion in the global markets. So those things can always create some volatility in the currency. So it's not impossible that rupee can depreciate a little bit from here, but I don't think it's going to settle down at a lower level. I think there are more chances of appreciation than depreciation for the medium term.
Sukumar, I just want to quote from a Market Insight report that your team recently sent to its investor, and it says, and I quote, that global and local events over the past few months have made market participants, the media and the other observers overtly negative and bearish. Is the point that is being made is that things are not as bad as they are being made out to be?
Yes, that is by and large true, both from a global, in the global context as well as in the local context. Global context, if you see, the earnings of a lot of companies are still holding up, whereas if you look at the equity risk premium in many of the countries, it's close to it's in double digits, which is much higher compared to a historical average. And in the case of India, again, I think there's a lot of pessimism about the outlook of companies. And if you look at the results, it's a mixed bag. There are companies which are surprising positively as well.
In this report, you also make a very interesting point. You say that if you take a 10-year period, and an investor who had stayed fully invested in the BSE Sensex would probably be sitting on 18% compounded returns, and somebody who missed the best 40 days would actually be negative, almost 5%. Could you articulate for our viewers what really should their strategy be at this point of time? We've seen retail investors sitting by the sidelines, not stepping in, not investing, many of whom have actually even stopped their SIPs. What would the advice be to investors at this point of time?
Yes, I think that's a very valid point. So my advice is the asset allocation, people should not be trying to time the market. They should decide on what is the proper allocation considering the risk that they can take and other investment objectives. And I think once they decide on the asset allocation, they should just stick to it. If, for example, if they think the right allocation into equities is 40%, I think they should just stay with it rather than say that, I will just have 5 or 10% in equities, and I will increase it once I see signs of the market picking up. Because when the market starts picking up, we don't know the speed at which it can pick up, and many people tend to miss, the best part of the rally.
All right, we leave it there. Thanks very much, Sukumar, for coming by and sharing your thoughts with our viewers here on Bloomberg UTV. All right, that was our Sukumar of Franklin Asia Equities. We take a quick break, but lots more coming up here on Bloomberg UTV.